Could running your money through an undisclosed country tank your share price? Let's take a look. Elliot from Abroad in here with this week's recap of HBO Industry Season 4, Episode 3, Financial Terms Breakdown. Unlike last week's episode, this one laid the financial terms on heavy and thick. Here are the 3 concepts we think you should know about. First, let's start with the fintech in the series, Tinder. That's Tinder with an E, not with an I. In this episode, Tinder's business ambitions become much clearer. First, we get hints of what the show is calling jurisdictional washing. Now, pretty much what's going on is that there's rumors that Tinder is running transactions through a third country and then repackaging them to make their balance sheet look stronger. This effectively allows them to clean what would otherwise be suspicious transactions to keep them above board with investors and the regulator. If this sounds a lot like money laundering, it is. It checks all 3 stages of the money laundering process: placement, layering, integration. Not a good look. And I'm sure we're going to learn more about it as the season progresses. The other big storyline around Tinder in this episode is their push to acquire Austrian bank IBN Bauer, a fictitious traditional institution over 300 years old. Tinder's goal is to buy them so that they can acquire their banking license. Getting a license here in Europe is by far one of the biggest hurdles early stage fintechs face. The application process can easily take years and cost hundreds if not millions of euros. Trust me on this. For this reason, many fintechs find it much faster and more cost-effective to just go out and acquire an already regulated institution, merge with them, and get their license to do whatever they want within the law. However, where this gets kind of strange for us is that it doesn't really align with Tinder's current goals. Tinder is acquiring an Austrian bank, which would give them permission to operate in the Austrian market and across the EU if they apply for their passport. However, since Brexit means Brexit, a banking license in the EU isn't valid anymore in the UK. Tinder might get this license in Austria, but it's not going to help them operate and hit their goals in the UK, which is kind of what they're trying to go for to begin with. So we're very curious to see how this is going to play out, at least in terms of the regulatory situation and their overall business objectives. Next, let's quickly look at what's going on with Harper and her former boss from Pierpoint, Eric Tao. Harper is still dead set on doing a short-only fund to profit on market misery. She brought in Eric to help her with this, and he's taking the lead on the sales. During a sales pitch with high net worth individuals and their advisors, we learned that most people are very skeptical of Harper's thesis. To raise the money for this fund, Eric strikes a deal with one of the investors called a first loss agreement. Eric has agreed to pledge $10 million versus the $90 million of another investor. What will happen in this sort of agreement is if the fund loses money, it comes out of Eric's share of the investment first, protecting the other investors and putting a ton of risk onto Eric. This is high risk for anyone, and to be clear, we only see these arrangements at the upper echelons of the investment world for professional or qualified investors. It is absolutely not common and likely illegal in most jurisdictions for retail investors, aka you and me. If someone proposes this sort of deal for you, run. That's it for this week's breakdown. There were tons more topics to talk about. We cover it all in our newsletter, so be sure that you're subscribed to it. It goes out every Monday. We'll be back next week, so give us a like, follow us, and I will see you at the next one. Have a great day.